Thanks very much, Aditya. It's a real pleasure to be here. I think both of us are quite excited about what we are seeing in the Indian space. Now, I in fact started my career with Citi in India, spent 9 years there, and then moved to London. So I had the privilege of being part of a pretty interesting capital markets journey over the last 30 years, pretty much. Let's move on to the first slide, and let me talk through a little bit of that capital market journey of the last 3 decades, because I think it sets the context for what we really want to talk about today. So back in 1990, when I joined the bank, it was all largely manual operations. There were armies of traders and brokers through whom we had to go through a relatively painful process of price discovery for pretty much any asset class. I was mainly in the FX and derivative space, where again, it was quite complex. But it was all paper-based processes, largely voice dealing. When we talked to our clients, everything was over voice. And primarily, it was vanilla products. But it was painful from a process perspective. A lot of manual processes all over the place. Now, as we went through the 90s, I think we started seeing a certain amount of complexity coming into the market. Towards the end of 90s, you might remember that there was a dot-com bust, and that was probably one of the key catalysts for a lot of interest in capital protection. So people wanted exposure to markets, but without having to risk their capital. And that was possible through combinations of bonds and options, as many of you on this forum would be aware. So we also saw, as we got into the 2000s, some increasing automation. While pricing was still controlled by traders, there was still a certain, quite a bit of automation which started to happen. And that's when we really started seeing the advent, early 2000s, the advent of structured products, so structured investment products in a big way. Mainly at that time, it was around key themes that products were being created. But increasingly, as we went through the 2000s, the products started getting more and more complex. And it was that excessive complexity as we came towards 2008, as many of you would remember, that led to the global financial crisis. There were those, second derivative products using complex credit derivatives on subprime mortgages, which really led to it. But there were a whole host of other structures also, which I think were causing a lot of headaches. And while not going into all the details of what really happened during the GFC, I think there's been more than enough talked about and written about on that space. But really, what started happening was after the GFC, there was a huge amount of regulatory scrutiny around these products because people lost a lot of money. Banks lost a lot of money. They didn't have the right risk management. They didn't have the right disclosures. As a result, the regulators asked many of the banks in this part of the world to actually make good a lot of the customers, so which again was a huge hole for banks who had already lost a lot of money in the GFC. But around that time, we started seeing, this was the early 2010s, we started seeing huge advances in electronic trading. We saw auto trader, or rather robots replacing human traders, and electronic dealing across multiple asset classes. And it was this multi-bank revolution, which FinIQ was very much a part of in terms of being able to provide much more efficient pricing ability and much more efficient price discovery for the end investors, as well as end-to-end automation, which finally led to a re-emergence of structured products. I think from around 2013-14 onwards, this market started recovering. And I think in India also, it had died a natural death, but across the world, it died a natural death for a while. But then it started recovering. And we've seen a large part of that over the last few years. Next slide, please. So if you look at what really has contributed to the global evolution, the first thing was the regulators started getting more comfortable. They did bring in a huge amount of regulation. In fact, some of those terms, some of those acronyms, MiFID II, PRIP, KID, these are all things we saw mainly in Europe, but across Asia, across US, Latin America, we started seeing similar kinds of regulation, which was part of the process through which the regulators became more comfortable with these products. KID, for example, is like a 40-page document that has to be shared every time a structured product is issued. So it's a key information document. And that includes comprehensive scenario analysis, risk disclosures, all kinds of disclaimers to make sure that the people who were buying these products were actually comfortable and familiar with these products. And at the same time, there was a huge requirement for technology to be playing a very important role. And that role was to create the ability for best execution through multi-bank pricing, as well as automation of pre and post-trade processes and the life cycle. Now, if you think about these products, a lot of them involve barriers, they involve coupon payments, they involve impact because of corporate actions or dividend payments on the value of the product. So tracking the mark-to-market, tracking collateral against the mark-to-market becomes a very, very important part of being able to manage the risk around these products and managing the client communication around these products. And that is exactly where automation and digitization played a very, very important role. And we'll talk about some of the things that we in FinIQ did in order to allow that to happen. The product structures themselves evolved quite a bit. There was a demise of those black box, CPPI stands for Constant Proportional Portfolio Insurance, which was essentially something which allowed the sellers of the product to say that, look, you would be capital protected with more money being invested into a particular underlying as the value of the underlying increased. But almost inevitably, it was a complete black box. Nobody quite knew what was going on inside the structure, and people usually ended up with just their capital and nothing else. So that was something which the regulators were not comfortable with. Also, post GFC, the interest rates across the world fell to pretty much zero. In fact, it was negative in the Eurozone. So the focus turned from a lot of interest rate linked structures, as well as some of these CPPI structures, to more of equity linked, which had to be partial or even non-capital protected to allow for some more value to the investors. And I think increasingly we started seeing these products starting to generate real value to the investors, which is why on the one hand, the investors started getting more comfortable with the products, the regulators started getting more comfortable. You've seen a lot of callables and reverse convertibles. That I think is the bulk of the products, and more theme-based kind of structures which would allow people to express a certain view on the market. So the private banking kind of clients or the high net worth individuals would say that they wanted a particular view on certain stocks, and those could be created in a much more efficient manner using these kind of structured products. Mahesh, would you like to talk about what has been happening more recently?
Sure. So hi, good evening, everyone. Just kind of taking on from what Sandip was saying before, on the regulatory front, we did see simplification of the products. And there was also a focus on making sure that the client understands the product. Now, how do you make sure that client understands the product? Again, the implementations vary from one region to another, but the broad principle is that if the client is going through a actively managed portfolio, then that manager is by nature a professional and qualified, and there are no further questions asked. But you do have several self-directed clients who make their own investment choices. And in that case, bulk of the countries, they divide the clients into two segments, and the names will change from country to country. But at a high level, we think about them as professional and non-professional. So a professional client is typically somebody who's rich, who has got the experience, has got the qualification to understand relatively more complex structures, and therefore requires a lower degree of protection. And the non-professional is, for example, my mom, right? So somebody who won't understand these complex structures and requires much higher protection from regulators. And the idea is that a client who's professional for a self-directed account must agree in writing to be classified as professional. And that's quite a key driver here. Most clients who are sophisticated would agree, because they realize if they don't agree, they will not be shown these interesting complex structures. And they also realize once they agree, they can no more run to the regulator and complain saying, I bought this product, I didn't quite understand, can you help me out? Because by signing this letter, you are telling everybody, not only the bank, but also your regulator, that you know what you're doing. Okay, so that's the way the market is getting split into sections. For the lower level, the retail side, the products had to be even much simpler, and there has to be a lot more protection. Yeah, so that's the broad picture. Yeah, so now we can go to the product mix on the next slide. So FinIQ has a platform which is used for trading structured products. And this is the data I'm showing to you is from Hong Kong, Singapore, and Dubai. So aggregated for those three places. The reason I chose this is because this is where you see products being traded on the fly in real time. So what does it mean? If you look at any other market other than Hong Kong, Singapore, and Dubai in Asia, so if you look at Korea, for example, if you look at Taiwan or look at Japan, the way people deal there is they will create a structured product, launch it, and let everybody place an order. So I place an order for $100,000, somebody places for $50,000, do an order gathering exercise for 2 days or a week or 2 weeks, and then go and issue the note for a large size. In Hong Kong, Singapore, and Dubai, and in Europe, in Switzerland, but I have not included Switzerland data here, the way of operating is very simple. A client comes, as long as they have minimum $200,000, they can create their own payoff and they can trade on the fly. So that requires a real-time connectivity to the market. And later on, Sandeep will show you a video clip showing how we have created real-time connectivity in Asia and Europe. Now, if you look at the product mix, and I pulled out data for 2021, and this is representing about $60 to $65 billion of volume traded on the platform. And you can see two large pies. One is called a fixed coupon note, and second is an accumulator. And again, I will not go through details of what those products are, but the important thing when you think about these products in the context of Indian market is that these products are longer. So rather than being 3 months in maturity, they tend to be between 18 months to 3 years in maturity. Okay, so they're longer products, longer dated. And equally importantly, the investor here is selling volatility in different ways. So why that is important is because when you only have principal guaranteed structures where the investor is buying a call option, the investor is always buying volatility. And that creates a problem of liquidity because it's a one-way market. Every investor just wants to buy volatility. Somebody has to sell it. And that's what we are seeing in India currently, where bulk of the volumes are in the short-dated market. And to create a bit more kind of 1, 2, 3 year market, it will be good to get a mix of products somewhere where the client is not necessarily always buying volatility, but mix it up with products where the client is selling volatility. So from the point of view of dealers, they get a two-way flow, and they are a lot more comfortable taking some positions, knowing that in near future, they can exit that position by issuing a different product on the other side. Now, you can also see that, there are a host of other products. For example, you see a average auto call CNST, vanilla option, they are small. And they bring the variety. It's important to have that variety. There are something like 15 or 20 payoffs which are getting dealt in the market. But bulk of it, 28 plus 54%, which is what 82%, is coming from fixed coupon notes and accumulators. And similar pattern is seen in Europe as well. In Europe, we have a auto call and we have reverse convertible. These two together make about 60-65%. So the pattern is 2 or 3 payoffs, they make bulk of the volume, and then you have small slices of other payoffs, which together kind of keep the interesting minds happy and occupied. Okay, let's go to the next slide. This is kind of a chart showing you how the volumes rise and fall. And this is very representative of what happens in a typical year. I use the word typical. I'll come back to say why I qualify it. So essentially, because this is a individual market, most individuals, they come back from their Christmas holiday in January, and they have some targets for the year. They want to make money. They are very excited, very interested. Just like when we come in January, most of us, we hit the gym. We want to lose weight. We want to build some muscles. And by March, April, all the New Year resolutions are kind of going away. You see a similar pattern here as well. A lot more activity in January, February, and then it quietens down. And in some parts of the world where summer is a huge thing, a lot of people are on holiday, you see a very lean August. In some other parts, you don't see that. And then, December tends to be relatively quiet. This year has been very different. When the market started in January 2022, it started on the back foot. The equity market has been down in the US, which is where bulk of the underlyings are picked from. The Hong Kong market is another area where we see a lot of underlyings, but even as you know, Hong Kong, China markets have been down this year. So the markets are more subdued. Volumes are about 50% so far compared to last year. And as we are now starting to see some of the concerns around inflation going away and perhaps some rally coming in, we might see a very busy fourth quarter. So we might see a very different pattern than what's a typical pattern for the volumes. Next slide, please. Yeah, I think maybe Sandeep, I can hand over back to you.
Yeah, sure. So I think we obviously have talked a little bit about the global context, and it's very important to kind of correlate that to what's been happening in India. And I find this somewhat of an anomaly that actually India has been at the forefront of the fintech innovation, which in many ways has contributed to the global re-emergence of structured products. In fact, one of the things I always say is that when I go to pretty much any bank anywhere in the world, we find that the structured products team will either have French people or Indian people as the largest contingent. And whether it comes to the structuring of the product, the sales of the product, the technology behind the products, I think we have been very much at the forefront. So the overseas market has evolved rapidly, especially over the last 5 to 7 years, thanks to increasingly client-friendly structures which have actually been found to provide very good and efficient means of expressing a certain view on the market. But that, unfortunately, has not quite happened in India as yet, although we are starting to see a little bit of it. But why hasn't it happened? I think there are certain pain points. Most of us would be very aware that there's a lack of liquidity for long-dated options in India. And there are many reasons for that, but I won't go into those. But at the moment, that's a key pain point. Individual strategies for clients is just not there. I don't think it is, from a regulatory compliance as well as logistical perspective, it is not really possible. So most of the products that are being done are essentially, pooled structures where you have to build your book around it. There are still a lot of regulatory challenges around product complexity. And I think that was essentially the lessons from GFC, where the regulators were extremely concerned about the fact that individual clients as well as some of the SME corporates lost money, and the banks lost money because the risk was not being managed properly. So I think there's been like a negative reaction to that, which has not allowed for the products to be much more easily available. So it's really the concerns around the risk management framework, which I think have made the regulators more wary of really allowing this to grow in a way which the overseas markets have grown. So really, what is our mission here? And I think this is where FinIQ, we would love to play a much bigger role in terms of bringing home some of that global product expertise that we've created over the last 20 years to work with banks, brokers, regulators, and really try and create something which is going to allow for much more comprehensive product distribution. And part of that is also to have the ability to access liquidity in a way through technology, which was not really possible before around structured products. So, and we want to do it with appropriate disclosures and the regulatory compliance that is required to make sure that everybody feels comfortable and there's a certain level of transparency around the entire process. And also bring home some of the risk management or risk measurement tools that we have provided solutions around for many of the banks that we work with, to allow for the banks themselves or the wealth managers who are typically the ones who are providing these products today to be able to provide products and to manage these products much more efficiently, digital access to a much wider range of products, and be able to really express the kind of views on the market that we have seen as the driver of these products in the global context. So that's really what we would like to do. So let's look briefly at what is it that we are currently doing in the global context. So that gives you an idea also in terms of some of the things that have really allowed for this market to evolve much more rapidly over the last few years. So the first part, I think, is the live price discovery, the ability to see prices across multiple counterparties at the same time. As you know, these are complex products. And earlier, it used to be a painful process of price discovery where you would call up 5 banks, tell them what structure you wanted. Each one would go away, come back after 15, 20 minutes, half an hour, 1 hour, and tell you, okay, this is the price we can give you, but this is indicative based on where the market is. Then you go back and forth, try and talk to your clients. The entire process was broken, and it was not easy to do. So I think the live pricing, the ability to access multi-bank liquidity for these structures has been one of the primary drivers of the growth of this business globally. The book building and order gathering process was also quite manual across many banks. In Citi, where I worked, it was extremely manual, so it was painful. There were orders which were missed. We were trying to compile orders in different systems across multiple jurisdictions, which was often very, very complex and convoluted. So that process has become much more efficient now. The whole idea generation process. Now, if you think about it, we are trying to crystallize, or we are trying to formulate a structure based on certain views that our clients are expressing. And if you're not able to do that efficiently, then it's just not going to be possible to really do it well. So the whole process of communicating with the clients, getting their ideas, getting their views, and then creating the appropriate product to match those views is a very, very important part of the whole electronic trading process that has been created. Then, as I mentioned earlier, very, very important from a compliance and regulatory perspective, the pre-trade suitability. I think Mahesh also referred to the different kind of sectors, the retail versus the private banking sector. The pre-trade suitability and the kind of products are very, very different for those sectors. The credit checks that need to happen. So that entire process used to be manual. Now, increasingly, it is automated. So again, we provided multiple solutions around the space, including the ability to manage collateral when you, as a bank or as a wealth management provider, are dealing with multiple counterparties, where you're taking a certain amount of risk in order to provide to generate the liquidity of these products. So the whole collateral management with real-time mark-to-markets is a very important part of the automation that we provided. Post-trade processing, again, extremely important to be able to have the right kind of, let's call it, the term sheets that need to be generated, the confirmations that need to be generated. And that leads on then to the life cycle management, which I talked about briefly earlier, where there could be coupon payments, there could be barriers which need to be monitored, there could be all kinds of corporate actions, dividend payments, which can impact the performance of a product. Those need to be monitored. And again, very, very important to be able to do it electronically. And besides, the entire portfolio management across multiple asset classes, which include structured products, was a very, very big part of the functionality and features that we wanted to provide through platforms like the one you see on the screen in the middle of this slide. That's the kind of front end which we have started providing to a lot of the banks, where it's a white label front end, obviously, that they use for their clients to be able to see their entire portfolio and then to be able to do portfolio rebalancing on the fly, including all kinds of asset classes with structured products. Then the trade analytics. Again, very, very important when you think about the way that we are looking at structured products. We don't just look at them from the point of view of what's happening today. We want to look at what happened in the past, all kinds of back testing, and also try and stress test these for any kind of events that could happen in the future. So the analytics and the ability for the product and the sales team to communicate with the clients with all these, functionality in terms of the analytics around these products was a very, very important part of the automation again. And finally, reconciliations and settlements, which were again a very, very big part of regulators getting more comfortable with the idea that these products could be done suitably and without any kind of breakages in the process. So this is just a laundry list of everything that we are able to provide, from a pre-sales in terms of onboarding and content perspective, to the pre-trade process, which involves price discovery and everything else that needs to happen before a trade happens. Then the entire order flow, which I've already talked about to some extent, and really in terms of ensuring that the banks, as well as wealth managers or anyone providing these products, can manage the entire process of the orders coming from clients in a very efficient manner. The analytics that I just talked about, pre-trade and post-trade. And then in the entire post-trade process, a whole host of features that are required by many of the banks that we are working with to ensure that they have a very, very efficient process. And as Mahesh also pointed out, I think we are working with over 40 banks. I think that number has been increasing quite rapidly recently. So let's just take a brief snapshot. We like to talk about who are the large, this is literally our partners across the world. It's almost the who's who of the financial world. So pretty much every large financial institution is either a sell side or a buy side client for us. This is something we are particularly proud of, and we want to ensure that we can bring a lot of those solutions and expertise that we have created over the last 20 years to the Indian context. So I'm going to stop there, and we will go through a brief video. It's just a 2-minute video, which gives you a snapshot of what our platform looks like, and then we'll move into Q&A.
FinIQ first launched its EQ Connect multi-issuer platform in 2015. This platform offers fixed-based execution for Asia's most popular structured investment and OTC products. Euro Connect is the European equivalent of the same platform which is being brought to the market. Here the payoffs are more diverse. The non-flow products are covered by FinIQ SP Connect and support all possible payoffs via FinIQ UCP or user-configured products. FinIQ EQ Connect is the best execution platform for equity-based structured and OTC products. Within EQ Connect, bankers can auto-price autocalls, reverse convertibles, participation products, accumulators, decumulators, and credit tranches. On the autocall pricer, the banker can select and define the product parameters such as underlying product wrappers, important dates, early redemption parameters such as autocall coupon type, autocall trigger, Phoenix coupon parameters, define the capital protection of the product and alternate coupon. When happy with the product parameters, the banker clicks on price and receives a response from multiple counterparties. At this stage, the banker can email the best quote or email any of the non-best quotes to self, request a KID, or a term sheet. The banker can then place an order on the quote by filling in the notional and confirming other order details, upon which, the order is sent to the issuer for execution. Orders can then be monitored or tracked from the EQ Connect order blotter.
So just to finish, I think what we see is potential rapid growth in this space, in the structured product space in India, as we start getting more of this technology into the Indian context. And also, I think we find that the alternative investment funds, the whole AIF space, which uses a lot of the same instruments for the purpose of creating their structures, is also a space where some of the features and functionality and market access that we've created is going to be extremely useful. So we do see a significant amount of focus that we are going to bring into that space, creating the appropriate gateways between the buyers and the sellers of this kind of volatility, which Mahesh also talked about. And we are very excited to be working, hopefully going forward, with a lot of you who are on this forum to start creating this marketplace.